Hey guys, it's Josh. I promise you guys a little more information on where the market is and where it's heading and why I believe this. As I mentioned, I was at that conference last week and heard Barry Habib speak, and he went over a lot of really insightful information. And the first thing I get a lot is, why did the Fed raise mortgage rates last week? Well, the Fed didn't raise mortgage rates. The Fed raised the Fed funds rate. So think home equity lines of credit, credit cards, auto loans, things like that. That's what's tied to that interest rate. Now, the difference is the same information drives both of those. So we're really talking about inflation. That's the number one thing that's driving everything right now. And high inflation leads to higher mortgage rates and a higher Fed funds rate. So they're indirectly correlated, but the Fed funds rate does not determine our rates. We actually are a little more forward looking than they are. And so we already had that anticipated. We projected that increase to happen. So the question is, what's going to happen in the short term? What's going to happen in the long term? In the short term, rates are likely going to, continue going up. And that's for a couple of reasons, one of which I'm going to show you in a second. Actually, let's look at this now. So this is the CPI, which is Consumer Price Index. It's the major inflation measure that the Fed looks at. And it is backwards looking 12 months, and it's cumulative. So this is not an average or a mean or anything else. You essentially take each one of these numbers over the past 12 months and you add them up, and that's where you get the number. Now, this is the core consumer price index. The difference is the core CPI strips out food and energy because those two items are not correlated with the economy. So, for example, the drought that we just went through drives up food prices, and Russia invading Ukraine drives up energy prices. So we strip those out and look at everything else that is left. So milk and eggs and things like that. Well, when you go back 12 months, when we got August reading a few weeks ago, it replaced August of 2021. Well, that number was extremely low. It was 0.2%. So even if our number had come in at zero, we're only picking up 0.2%. So in the short term, inflation can only go so much lower so quickly. And once we replace the September number, we're only replacing September of last year, which is 0.3. So again, that's a very, very low number. It's hard to make up any ground on that. However, you will notice that October of last year is when inflation started to become a problem. Of course, then you heard at the time that it was transitory, and of course, it turned out not to be. And so we look at 0.6%. When we get our October reading, let's say it's 0.3 or 0.4, well, now we start to pick up ground, right? Now you can see that inflation is going to start to go down. And so as inflation goes down, interest rates will go down with it. History says that's exactly what happens. However, this Fed has said that, hey, look, we need to get it down closer to 2%, and we need to keep it there. So they are going to be very hawkish, meaning they're going to be very aggressive raising those rates until they can get them down. What that means is, in the short term, rates are likely going to continue to go up for a little bit. And in the long term, rates are likely going to come back down. Now, I don't think we're going to see twos or probably even threes, but fours would be great, right? So if we could get the mortgage 30-year fixed into the fours, you're going to see a very healthy housing market here locally and nationally. And so I think that's kind of what you need to look for. The other thing to keep in mind with your clients is, right now they can get the home they want under contract under their terms. If rates go up, they're better off buying now. If rates go down, which we think they will as well, then they can refinance to that lower rate. So right now is a kind of unique time in the market, and I think we need to do a better job of explaining that to them and the opportunity that they have now. If they wait for interest rates to go back down, well, everyone else is waiting as well. They're going to jump back in the market, and even though supply has gone up, we're not looking at even 2019 supply numbers. These supply numbers are not that high, relatively speaking, and so as people jump back in the market, then it's going to make that supply shorten, demand goes up, and it's going to be tough again. So please reach out if you have any questions. I'd love to explain this in more detail, but I was trying to keep it short today. Just let me know if I can help. Thanks, guys. Bye.